Most people think the stock market is the most important market in the world, but that's not true. Because if you really want to understand money, how it moves, how it grows, how economies expand and collapse, you have to understand one market first. The bond market. If you don't understand bonds, you don't understand money. You probably ask yourself why. Well, the reason is actually very simple. When you think about investing, you usually imagine the stock market companies, businesses, growth, innovation. That's the exciting part of finance. It's the part that gets on television, the part that people talk about at dinner. But the stock market doesn't actually set the price of money. The bond market does. And once you understand that idea, a lot of things in the world suddenly start to make more sense. Mortgage rates make more sense. Credit card interest rates make more sense. Why companies invest or stop investing makes more sense. Even why stock markets go up or down starts to make more sense, because bonds determine something fundamental in the economy, the cost of money. And the cost of money influences almost every financial decision made by governments, companies, and individuals. So if someone tells me they want to understand markets, but they ignore bonds entirely, that's a little like someone saying they want to understand weather, but they refuse to look at temperature. Temperature drives everything else. And in finance, bonds are very close to that temperature.
But for a lot of people, bonds feel confusing or boring. They hear the word and think, okay, that's for retirement portfolios or pension funds. So before we go deeper, let's start at the most basic level. What actually is a bond?
A bond is actually one of the simplest financial instruments that exists. It's just a loan. That's all it is. When you buy a stock, you are buying a piece of a business. When you buy a bond, you are lending money. That's the entire idea. You lend money to someone and they promise two things. First, they promise to pay you interest. Second, they promise to give your money back later. That's it. And the borrower could be several different kinds of entities. It might be a government. It might be a corporation. It might be a municipality, a city or state, but the structure is always the same. You lend money today. You receive interest payments, and at some future date, you get your principal back. Now, because that structure is simple, bonds become a kind of foundation in finance. They represent the basic relationship between money and time. Someone needs money now. Someone else is willing to lend it. And the price of that relationship is the interest rate. That's the essence of the bond market.
So a bond is basically an IOU.
Exactly. That's the simplest way to think about it. It's an IOU. If the US government issues a bond, they're essentially saying, lend us this money today and we promise to pay you interest every year and we'll return the full amount later. Companies do the same thing. If a large company wants to build a factory or expand operations, it has two main choices. It can sell stock, meaning it gives away ownership, or it can issue bonds, meaning it borrows money. Many companies prefer bonds because they don't want to dilute ownership, so they borrow. And investors who buy those bonds are effectively the lenders.
But if bonds are just loans, why are they so important? Why do they influence everything?
Because bonds determine the baseline return on money. Think of the financial world as a ladder of risk. At the bottom of that ladder are the safest investments. In the United States, those are usually US Treasury bonds. They're considered extremely safe because they're backed by the US government. Now, every other investment in the world is measured against that baseline. Let's say a Treasury bond pays 4%. That means an investor can earn 4% with very little risk. So if a stock wants to attract investors, it needs to offer the possibility of more than that. Otherwise, why take the risk? And this creates what we call the risk premium, the extra return investors demand for taking more risk. So if bonds yield 4%, maybe stocks need to offer the potential for 7% or 8%. If bonds yield 6%, suddenly stocks need to offer much more. And when bonds start paying more, investors sometimes shift money out of stocks and into bonds because bonds become attractive. That's one of the reasons the bond market has such influence over the stock market.
So in a way, bonds are setting the speed limit for returns across the entire financial system.
That's a good way to think about it. They establish the starting point. Every other investment builds on top of that. And when that starting point changes, when bond yields rise or fall, it sends ripples through every other market. Housing, stocks, private businesses, even government spending. Everything is connected to the cost of borrowing money.
If someone listening has never studied bonds before, what are the basic components they need to understand?
There are really just four ideas. Once someone understands these four, they understand the mechanics of bonds. The first is principal. That's simply the amount of money being lent. If you buy a bond for $1,000, that's the principal. That's the amount you expect to get back at the end. The second concept is the coupon. That's the interest payment. Historically, bonds actually had little paper coupons attached to them that investors would clip and redeem for interest payments. So the name stuck. If a bond has a 5% coupon on a $1,000 bond, that means you receive $50 per year. The third concept is maturity. That's the date when the borrower returns your principal. Some bonds mature in 1 year, others in 5 years, 10 years, even 30 years. And the fourth concept, which is where things become more interesting, is yield. Yield is the actual return you receive based on what you paid for the bond, because bonds trade in markets just like stocks do. And once people understand how yield works, they start to understand why the bond market moves the way it does. But yield is also where many people get confused. And that's probably the most important concept we'll break down next.
So if someone understands principal, coupon, maturity, and yield, they already understand the basic language of the bond market.
Yes. And once you understand that language, the rest of the bond market becomes much easier to interpret. Because all the headlines you hear, interest rates rising, bond prices falling, yields moving, they all come back to those few core ideas. And the relationship between those ideas is what drives the entire system.
Earlier, you mentioned that yields are where most people get confused. And if someone has ever tried to read about bonds, they've probably seen this statement: when interest rates go up, bond prices go down. And that alone makes people feel like they're reading another language. So let's slow that down. Why does that happen?
Yes, this is the point where most people feel like bonds become complicated. But once you see the logic, it actually becomes very intuitive. The key thing to understand is that a bond is a fixed agreement. When you buy a bond, the terms are already set. The interest payment is fixed. The maturity date is fixed. The borrower has already promised exactly how much they will pay you. But the world around that bond keeps changing. Interest rates change. New bonds get issued, and when those new bonds appear, they can make older bonds either more attractive or less attractive. Let's imagine a very simple example. Suppose you buy a bond today. You lend someone $1,000. They promise to pay you 5% interest per year. So every year you receive $50. That agreement is fixed. It doesn't change. But now imagine that a year later, new bonds are issued, and those new bonds pay 7% interest. Suddenly, investors have a choice. They can buy your bond that pays $50 per year, or they can buy a brand new bond paying $70 per year on the same $1,000. Now ask yourself a simple question. Which one would investors prefer? Obviously, the new one. So if someone wants to sell the old bond, the one paying only $50, they need to make it more attractive. And the only way to do that is by lowering the price.
So the bond itself didn't change. The market around it changed.
Exactly. And that's the most important insight. The bond contract is fixed, but the price investors are willing to pay for that contract moves constantly. So if the bond that pays $50 per year used to cost $1,000, maybe now it only sells for $900. Now something interesting happens. The bond still pays $50 per year, but if someone buys it for $900 instead of $1,000, their return is higher. $50 divided by $900 is a higher yield. And that adjustment is what brings the bond back into balance with the new interest rate environment.
So bond prices and yields move in opposite directions.
Yes. Think of it like a seesaw. On one side, you have price. On the other side, you have yield. When price goes up, yield goes down. When price goes down, yield goes up. And that relationship is fundamental to how bonds work. Because investors are constantly comparing, what return can I get from this bond versus a new one? And that comparison forces prices to move.
Now let's connect this to something people hear about all the time: interest rates. The Federal Reserve raises rates. Markets react. Mortgage rates move. Why does the bond market respond so strongly to interest rates?
because interest rates are essentially the price of borrowing money, and bonds are loans. So if the price of borrowing money changes, every existing loan suddenly needs to be reevaluated. Imagine you own a bond paying 3%. Now imagine the Federal Reserve raises rates and new bonds start paying 5%. Your bond becomes less attractive, not because it's bad, but because the market now has better alternatives. So the price adjusts downward until the yield becomes competitive again. And the same thing happens in reverse. If interest rates fall and new bonds pay less, older bonds with higher interest payments suddenly become very valuable. Their prices go up.
But here's the interesting part. Most people listening don't actually own many bonds. They might own stocks, maybe a retirement account. Why should they care about this relationship?
Because bonds influence the cost of money everywhere. When bond yields rise, borrowing becomes more expensive. Mortgage rates rise. Car loan rates rise. Credit card rates rise. Companies borrow less money because debt becomes more expensive. And when companies borrow less, they invest less. And when they invest less, economic growth slows. You start to see layoffs. You start to see businesses delay expansion. So even if you never buy a bond in your life, the bond market still affects you. It affects the cost of buying a home. It affects the cost of running a business. It even affects the stock market. Because when bonds offer higher returns, investors sometimes move money out of stocks and into bonds. That's why the bond market often acts like the gravitational force of finance. Everything else moves around it.
So if someone is trying to understand markets, stocks, housing, inflation, what you're saying is they can't ignore bonds.
That's right, because bonds tell you something extremely important. They tell you what money costs. And once you know the cost of money, you understand the foundation that every other investment decision is built on. If money is cheap, people borrow. Businesses expand, stocks often rise. If money becomes expensive, borrowing slows. Growth slows. Markets become more cautious. So when investors ignore the bond market, they're ignoring the very mechanism that sets the pace of the economy.
All right. So now we understand what a bond is, the four core components, why yields and prices move in opposite directions, why interest rates change everything. But here's where the story gets bigger. Because bonds don't just affect investors, they affect the entire economy. So tell us, why does the bond market have so much power?
Because governments run on borrowed money. That's really the starting point. People sometimes imagine governments operating like households, collecting taxes, paying expenses, and that's the end of it. But modern governments are much larger financial machines than that. They constantly borrow, and they borrow by issuing bonds. In the United States, these are called Treasury bonds, and the Treasury market is enormous. When investors buy Treasury bonds, they're essentially lending money to the US government, and the government promises to repay that money with interest. Now, the reason Treasuries are so important is because they are widely considered one of the safest investments in the world. Not because governments are perfect, but because the United States has an extraordinary ability to raise revenue and service its debt. So Treasury bonds become the benchmark. Everything else in finance starts with that benchmark.
Meaning the Treasury yield becomes the reference point.
Exactly. Think of it like gravity. Treasury yields create the gravitational center of the financial system. Every other interest rate in the economy moves relative to that. Corporate bonds, mortgage rates, car loans, student loans, credit cards, all of them are priced relative to Treasury yields. If Treasury yields go up, borrowing costs go up everywhere. If Treasury yields fall, borrowing becomes cheaper across the economy. So when investors watch the bond market, they're really watching the price of money itself.
Let's take something people understand. Housing. How does the bond market affect mortgage rates?
Mortgage rates are closely tied to the 10-year Treasury yield. And that connection exists because of how mortgages are structured. When a bank issues a mortgage, it's essentially lending money for a long period of time, often 15 years or 30 years. But banks don't usually want to keep that loan on their books forever. So those loans often get packaged and sold to investors. Investors buying those mortgage-backed securities compare them to Treasury bonds. They ask a simple question: if a Treasury bond pays this much, how much extra return do I need to justify owning a mortgage? Because Mortgages carry a little more risk. So mortgage rates end up being a spread above Treasury yields. And that's why when the 10-year Treasury yield rises, mortgage rates usually rise too. You can watch it happen almost in real time.
So when people complain about mortgage rates rising, they're really seeing the bond market move.
That's exactly right. And this is why bonds affect everyday life more than people realize. When yields rise, homes become more expensive to finance. Car payments rise. Credit becomes tighter. Businesses slow down investment. The whole economy starts cooling. It's very much like a thermostat. The bond market adjusts the temperature of economic activity.
And this also affects the stock market.
Yes, because investors are always comparing returns. If Treasury bonds are yielding 2%, investors might be willing to take more risk in stocks because stocks might offer 7% or 8% over time. But imagine Treasury yields suddenly rise to 6%. Now, investors can earn a respectable return with much less risk. So some money moves out of stocks and into bonds. This is why rising interest rates often pressure the stock market. The competition for capital changes. Investors are constantly deciding where their money should go, and bonds are always part of that decision.
This is where we hear the phrase risk-free rate, right?
Yes. The risk-free rate is essentially the return investors can get from something extremely safe. In practice, that's usually Treasury bonds. So if Treasuries yield 4%, that becomes the baseline. Every other investment must justify why it deserves to earn more than that. If a company's stock is risky, investors demand a higher return. If a corporate bond carries some risk, it must offer a higher yield. Everything builds on top of that risk-free foundation. And when that foundation moves, the entire structure shifts.
There's something interesting here. A lot of younger investors say, I don't own bonds. But from what you're saying, they're still affected by bonds.
Very much so. Even if someone never buys a single bond in their life, they are still living inside a bond-driven economy because the bond market determines the cost of borrowing, and borrowing determines the pace of economic activity. Businesses borrow to expand. Governments borrow to spend. Homeowners borrow to buy property. Students borrow for education. So when the bond market moves, it's like someone quietly changing the price tags on the entire economy. And most people don't even notice the mechanism behind it. They just feel the effects.
So when investors like you analyze markets, you're always aware of interest rates and bond yields.
Always. Because the value of every investment ultimately depends on the cost of money. If money becomes more expensive, future profits become less valuable today. If money becomes cheaper, future profits become more valuable. So understanding bonds helps investors understand the environment they're operating in. It doesn't predict everything, but it provides important context.
All right, so we now understand why the bond market matters so much. But now there's a natural question. If bonds are basically loans, why do some bonds pay 3%, others 5%, and others 10% or more? What determines that difference?
The difference comes down to risk. Whenever someone lends money, there is always a question in the background. Will I get my money back? That's the most important question in lending. If the answer feels very certain, the interest rate can be low. If the answer feels uncertain, the interest rate must be higher because lenders need compensation for taking that risk. So when you look at the bond market, what you're really seeing is the market constantly evaluating creditworthiness. How reliable is the borrower? How stable is their income? How likely are they to repay the debt? The safer the borrower appears, the lower the interest rate they can offer. The riskier the borrower appears, the higher the yield investors demand. And that basic principle explains why different bonds pay different returns.
So this is why government bonds usually pay less than corporate bonds.
Yes, in the United States, Treasury bonds are considered extremely safe. So investors accept relatively low yields. They are essentially saying, I'm willing to earn a lower return in exchange for very high safety. Now compare that to a corporation. Even a strong company carries more risk than the US government. Companies can lose money. They can go bankrupt. Their industries can change. So investors lending money to corporations usually demand higher interest rates. That extra yield is compensation for the additional uncertainty.
This is what investors call credit risk, right?
Exactly. Credit risk is simply the risk that the borrower might fail to repay the loan. And the bond market spends an enormous amount of time evaluating that risk. There are rating agencies whose entire job is to analyze borrowers. They study financial statements, debt levels, cash flow, industry conditions, and based on that analysis, they assign ratings to bonds. You might hear terms like AAA, AA, A, BBB, and so on. These ratings are simply attempts to measure the likelihood that the borrower will repay the debt. The higher the rating, the safer the bond is considered. And the safer the bond is considered, the lower the interest rate investors are willing to accept.
And at the other end of the spectrum, we hear about something called junk bonds.
Yes, that's a colorful name for bonds issued by borrowers that carry significant risk. These companies may have high debt, unstable earnings, or industries that are going through difficult periods. Because the risk is higher, they must offer much higher yields to attract investors. Sometimes those yields can be quite tempting, and that's where investors need to be careful. A high yield often signals high risk, and while some investors specialize in analyzing those opportunities, it's important to remember that lending to weaker borrowers can lead to losses if the borrower cannot repay. So the bond market constantly balances two things: safety and return.
It almost sounds like everyday lending, like a bank deciding whether to give someone a loan.
That's exactly what it is. In fact, if you strip away all the complexity of finance, the bond market is simply a very large lending marketplace. Millions of investors around the world are constantly asking, who should I lend money to? And borrowers are constantly asking, how much interest do I need to offer to attract those lenders? The bond market simply matches those two sides. Lenders seeking return, borrowers seeking capital. And the interest rate is the price that balances those two forces.
There's another dimension here we haven't talked about yet: time. Some bonds mature in 1 year, others in 10, others in 30. Why does that matter?
Time introduces another layer of uncertainty. The longer you lend money, the more things can happen. Inflation can change. Economic conditions can change. Interest rates can move dramatically. So when investors lend money for a longer period of time, they often demand higher interest rates to compensate for that uncertainty. That's why long-term bonds often yield more than short-term bonds. It's simply compensation for tying up money for a longer time. But sometimes the relationship reverses. Sometimes short-term yields become higher than long-term yields. And when that happens, investors pay very close attention because historically that has often signaled economic stress ahead.
You're referring to something people hear about in the news, the yield curve.
Yes, the yield curve is simply a graph showing interest rates for bonds with different maturities. Short-term bonds, medium-term bonds, long-term bonds. Under normal conditions, longer bonds pay higher yields because investors demand compensation for waiting longer. But when the yield curve inverts, when short-term rates become higher than long-term rates, it often means the bond market expects slower economic growth ahead. And investors pay attention to that signal because the bond market often reflects the collective expectations of millions of investors around the world.
So when people understand bonds, they're not just learning about one type of investment. They're learning how the financial system itself works.
That's exactly right. Bonds reveal something fundamental about the economy. They show us how investors think about risk. They show us how expensive money is. They show us what expectations exist about the future. And when you combine those insights, you begin to understand the environment in which every other investment operates. That's why bonds matter. Not because they're exciting, but because they are foundational.
Now let's talk about something practical. How do investors actually use bonds inside a portfolio? Because many people think of bonds simply as something you add when you get older. Is that really the way to think about them?
That's a very common belief. And it's partly true, but it's also incomplete. Bonds serve a very different role from stocks. When you buy stocks, you are buying ownership in businesses. Over long periods of time, strong businesses grow. They increase earnings, they reinvest capital, and that growth can translate into rising stock prices. So stocks are typically used for long-term growth. Bonds are different. Bonds are primarily about stability and income. When you buy a bond, you usually know exactly what you're going to receive. The interest payments, the maturity date, And, when your principal will be returned, that predictability makes bonds useful in a portfolio for a completely different reason than stocks. They reduce uncertainty.
So bonds act as a stabilizer.
Yes. If someone puts all of their money into stocks, their portfolio will experience large swings. Sometimes those swings are upward. Sometimes they're downward. Over long periods of time, stocks have historically performed very well. But along the way, they can be extremely volatile. Bonds can help smooth that volatility because bonds typically behave differently from stocks during periods of economic stress. When markets become uncertain, investors often move towards safer assets. And bonds, particularly high-quality government bonds, can benefit from that shift. So in a diversified portfolio, bonds often serve as an anchor, not something that grows dramatically, but something that provides stability.
And there's also the income side.
Exactly. Bonds produce predictable income. Every year you receive interest payments. That income can be very valuable depending on an investor's situation. For someone who is working and earning a salary, income from bonds may not be very important. They may prefer to focus on growth through stocks. But for someone who is retired, the situation changes. Now, they may depend on their investments to provide cash flow. In that case, bonds can become a much larger part of the portfolio because they produce steady payments without needing to sell assets. That reliability is valuable.
So this explains why younger investors often hold fewer bonds.
Yes, younger investors usually have something extremely valuable on their side. Time. Time allows them to tolerate volatility. If the stock market falls one year, they still have decades ahead of them. Over those long periods, strong businesses have historically grown. So younger investors often emphasize stocks because they are seeking long-term growth. As investors get older, priorities sometimes change. Preservation of capital becomes more important. Income becomes more important. And that's where bonds often start playing a larger role. That reliability is valuable.
So bonds aren't really about getting rich. They're about controlling risk.
That's a good way to put it. Bonds are rarely the engine of extraordinary wealth, but they can be very effective at protecting wealth. And protecting wealth is just as important as building it. Investing isn't just about maximizing returns. It's about managing risk in a way that allows you to stay invested over long periods of time. If someone takes too much risk and experiences losses they can't tolerate emotionally, they may abandon their strategy entirely. Bonds can help prevent that. They can create a portfolio structure that people are able to stick with through both good times and difficult times. And in investing, consistency matters far more than occasional brilliance.
So when people build portfolios, they're really balancing two forces, growth and stability.
Yes, stocks provide growth. Bonds provide stability. And every investor must decide what balance makes sense for their situation. That balance depends on several things: their age, their income, their financial goals, their tolerance for volatility. There isn't a single answer that works for everyone. But understanding the role of bonds helps investors make that decision thoughtfully instead of emotionally.
It seems like understanding bonds is really about understanding something bigger, how money itself works.
That's exactly right. Bonds reveal something fundamental about finance. They show us that money has a price, and that price influences everything else. When money is cheap, people borrow more. They invest more. They take more risk. When money becomes expensive, people become more cautious. So the bond market is constantly signaling the cost of capital in the economy. And once someone understands that idea, they begin to see financial markets differently.
All right, we've talked about bonds as investments. We've talked about how they influence mortgage rates, the stock market, and the economy. But I want to step back for a moment. If someone truly understands bonds, what does that teach them about money itself?
It teaches them that money always has a price. And that price is determined by the balance between people who need money and people who are willing to lend it. In simple terms, the bond market is where that negotiation happens. Borrowers want the lowest possible interest rate. Lenders want the highest possible return. And the bond market constantly adjusts until those two forces meet somewhere in the middle. Once you understand that process, you begin to see how much of the economy is driven by the cost of borrowing. Businesses expand when capital is cheap. Governments spend more easily when borrowing is affordable. Consumers take mortgages when interest rates are low. But when the cost of money rises, behavior changes, borrowing slows, investment slows, and economic activity often cools. So the bond market is quietly influencing decisions everywhere.
There's something interesting here. A bond is really built on trust.
Yes, every bond is fundamentally an agreement based on trust. When you buy a bond, you are trusting that the borrower will honor their promise. That promise might extend 10 years, 20 years, even 30 years into the future. So the bond market is actually a massive network of trust relationships. Governments ask investors to trust that they will repay debt. Companies ask investors to trust that their businesses will remain profitable enough to service their obligations. Investors constantly evaluate that trust. And when trust weakens, interest rates rise because lenders demand more compensation for taking that risk.
You sometimes hear people say that the bond market is the smart money. Why is that?
Partly because bond investors tend to focus on risk more than excitement. Stock markets are often driven by stories, innovation, new technologies, growth projections, and those things can be very powerful. But bond investors are typically asking a much simpler question. Will this borrower repay the loan? It's a more conservative mindset. And because the bond market is so large, much larger than the stock market globally, its collective judgment can provide important signals about economic expectations. When bond investors demand higher yields, they are often expressing concern about inflation, credit risk, or economic instability. When yields fall, it often means investors are seeking safety. So the bond market reflects the combined judgment of millions of investors about the future.
And yet most people pay almost no attention to it.
That's true. The bond market is rarely exciting. There are no dramatic headlines about companies doubling overnight. No stories about revolutionary new products. It's quieter, more methodical, but in many ways it's the foundation of the financial system. Stocks may attract more attention, but bonds determine the environment those stocks operate in. They influence borrowing costs. They influence valuations. They influence economic growth. So even though the bond market doesn't always receive the spotlight, it quietly shapes the conditions that affect every other market.
If someone listening wants to remember the essence of bonds in one simple idea, what would it be?
I would say this: a bond is simply the price of money over time. That's really what it represents. It tells you how much someone is willing to pay today to use someone else's money. And when millions of investors participate in that process simultaneously, the result becomes the bond market. That market reflects expectations about inflation, growth, and risk. It's one of the clearest windows we have into how investors collectively see the future. So if you want to understand money, how it moves through the economy, how it influences investment decisions, how it shapes markets, bonds are a very good place to start.
So the lesson is simple. If you ignore bonds, you're ignoring the foundation of the financial system.
Exactly. Stocks tell you stories about businesses. Bonds tell you the price of money, and the price of money influences everything.
Thank you, Mr. Buffett.
Thank you.